Good day, everybody. It's Greg Schnell, and I am here with Martin Pring for Market Roundup going into August 2019. It is crazy how fast the year is spinning by, and I've got Martin with me. Martin, how are you?
I'm terrific, thanks, Greg. How are you?
I am very good. We have an interesting day to record this show after the Fed meeting yesterday, the wild swing in the markets, big changes in the commodities, lots going on in the currencies. It's going to be a very interesting chart review today. What have you got for us?
Quite a bit. And I agree that things are very finely balanced here. And there's some pretty scary stuff out there, but there's also some really encouraging stuff. And hopefully it'll all get sorted out in the next couple of weeks or so, and we can see what the true trends are. So let me get into the presentation here and summarize what we're going to talk about. Most indicators show the US economy is slowing, and some that the slowdown may be over. We'll get into that. There are more long-term stock market indicators that have gone bullish this month, or I should say last month, because we're in August now, but they haven't gone bullish decisively. So we want a little bit more strength in order to push them into a decisive bullish reading. We'll look at those. And the 12-month rate of change for the 10-year yield is overextended on the downside. And historically, when we've seen that, and when the rate of change is reversed, that's usually the end of the bear market cycle in yields, which is kind of not what you would expect, just having seen the Fed lower the discount rate. So we'll look at that too. Industrial commodities are long-term oversold, but they remain in a bear market. We don't see any signs that they're crossing any moving averages on the upside or anything like that, but they are very overextended on the downside. And that's not inconsistent with where we see bond yields. And so I'm watching the Canadian and the Australian dollars for clues on the commodity markets because they're both very closely tied into commodities. Today we look at the Canadian dollar right at the end of the presentation. So this first chart shows you the chemical activity barometer. This is the leading economic indicator put out by the American Chemistry Council. And I like it because we've got history going all the way back to the 1920s, and actually a little bit before then. And the indicator has led every recession since then by a range of, I think it's 2 to 14 months with an average of 6 to 7 months lead time. And so on this chart here, we're seeing the red highlights, which represent recessions, and the vertical lines represent the onset of a recession. So here's the recession starting, and here's the onset. And you can see what happens to the price oscillator, which is a 3-month moving average divided by an 18-month moving average. It's approaching or crossing below the recession line. And this happens fairly consistently all the way through. Sometimes the recession starts a little bit before it goes through, and sometimes it begins after it's gone through. And right now we were declining. There was a little bit of a rally going on now with the latest month's data, which is June's. It's turned down a little bit, but it hasn't crossed below the line. Every time it's crossed below the line, we've seen a recession. But what often happens when it approaches the line, and as it has now, is we get one of these green arrows, which indicate that the economy is rebounded as far as this indicator is concerned, and that the slowdown that was in process at the time has started to morph into more of a recovery stage. So right now we're kind of in no man's land here because it's still in a declining trend, but it hasn't fallen below the recession line. When you look at the actual index itself, you see it's basically been range bound for the last 18 months. So if it rallies up above the trading range here, that would obviously be positive for the economy because this is a leading indicator. But on the other hand, if it starts to drop, it's also going to drop below its 18-month moving average, and that's usually signaled a recession. So we could look at another indicator here, which is kind of interesting, and that is the yield curve. Now you can use yield curves over lots of different maturities. I'm looking at the 20-year against the 5-year in this instance. Once again, the red lines represent recessions, and recessions seem to begin when the yield curves starts to steepen and move away from an inverted situation. And you see it didn't invert or actually it didn't invert in 2006 here. So what we're seeing right now is the yield curve is steepening again, and that indicates a weakening economy, just as it did here. And then that weakening economy turned into a recession all the way through here. You see, it starts to invert, and then it starts to weaken by steepening. But you need two conditions for a recession. One is for the yield curve to steepen like it has, and the other is for the economy to actually get weaker. And this is our Pring Turner recession caller. This is again a momentum combination of 4 different leading indicators of the economy. And typically what happens is that when the recession begins, this indicator crosses below the recession calling line, which is just a little bit below the equilibrium line, which is just there. So right now what we're seeing, and I think these arrows are going to show us what happens after we cross the recession calling line, the indicator weakens and we go into a recessionary period. So right now, instead of going into a recessionary period, the indicator is actually adding a little bit of strength to what's going on here. It's kind of bouncing. So it hasn't given us a sell signal on the economy as it normally would by crossing below the recession line. So until it does, I'm going to remain positive on the economy. And the other thing about the yield curve is it's gained a lot of popularity in this particular cycle. And a lot of people have pointed out that it got inverted, and inversions have preceded all the recessions since 1955 or whenever it was. So from a contrarian point of view, I'm kind of a little bit skeptical about the yield curve, despite its very good record over the last 3 or 4 decades. Now, if this leading indicator here starts to turn down, that's going to turn me bearish. But on the other hand, I've got another leading indicator, which is a little bit stronger. Here we have the S&P on the top panel. Underneath is what I call my stock market kicker. This thing is a combination momentum indicator constructed from several leading economic indicators. And when it bottoms out from below zero, typically it's going to signal that a recession is probably ended, and we should be expecting a higher stock price. That's why I call it the stock market kicker, because it's very good for triggering bull signals on the stock market, going all the way back to 1955 or so. The one failure that it's had is not a failure in calling the economy as stronger in 2001, but its failure was that the economy the stock market did not respond to the economy. And that was a very, very unusual situation. 99 times out of 100, when the economy is going to improve, the stock market improves too and anticipates that. This was not the case, because that was in 2000, 2002 when we unwound the tech bubble. So it's had a pretty consistent record of calling stock market turns over the years, and when it reverses from zero or around zero or below zero, that's when we get one of these dash green lines. This kind of indicates that a slowdown is over. Then that also is positive for the stock market. The only time when it hasn't been super positive, it was in 2006, when it went up for about, it doesn't look very long here, but it's about 6 months or so. And we saw a similar thing back here in 1989, 1990, when it went up for about 6 months, or it certainly didn't go down. But by and large, when the stock market kicker comes in, it's very bullish for the economy. And as you can see, I'm just putting in another arrow here, indicating the indicators just went bullish a couple of months ago. And that supports the idea that we're going to be experiencing a recovery phase, a reacceleration in the growth path, as opposed to a contraction in the growth path of the economy, which would of course be a recessionary condition. So as long as its indicator is turning up, I'm fairly optimistic about the economy and the stock market. One indicator that may be in the process of turning is the Philadelphia Future Capital Spending Diffusion Indicator. And what we've got here is an MACD of that actual raw data. And the idea is that when we get a rally above the signal line here, that indicates that the stock market and the economy are likely to take off. And you can see that in pretty well every situation here as I go through, except for this this 2001 period again, the economy, the stock market rallies when the economy improves. Well, when we look at the current situation, you can see that the MACD is rallied up last month, but it's still a little bit below its signal line. If it crosses above that signal line, this is something I'm watching very, very closely indeed. That would be a strong indication or confirming indication of that previous chart that we saw before. So now we're looking at another indicator I haven't shown you, I don't think, before. This is a KST of the inverted dividend yield on the S&P. And when that inverted dividend yield starts to turn up, or the KST starts to turn up, cross above its moving average, that's what we're going to get one of these green lines. And you can see that pretty well all the way through, the green vertical lines indicating these buy signals have been followed by a nice rally in the stock market. Here we see it happening all the way through here. So last month, this indicator started to turn up again. They're very anemically, but it turned up, and that's what I was saying before, that if we get a little bit more strength, we're going to have a decisive signal, and that would add further to the number of bullish indicators in our indicator toolkit. So we're watching that one very closely indeed. Right now, it is turning up, and if we get a positive month in August, that'll get a little bit stronger, and we'll cross above the signal line. So that's encouraging, but it's not super bullish yet. Incidentally, since I can't remember, I think it was about 1900 or 1871, those days, you had 42 signals, only 5 of which failed in turning the stock market higher. So it's had a pretty good track record, just a little bit under 10 to 1 on the success side. So it's definitely worth watching for. This next indicator shows you the World Stock Index. And this time we're looking at the OECD leading indicator. We're not looking at the indicator itself because that's still falling. But what we are looking at is a derivative of the indicator where we divide a 1-month observation by a 15-month moving average. And the derivative turns up very slightly before the actual index itself. So the index now, I believe it's only plotted up to the end of May. So we're kind of behind on the data because we've got a lot of global series and they report fairly well after the fact. But in this case here, the indicator has just started to ever so slightly turn up. I'm not saying that's a bullish signal yet. I think it's an encouraging sign that the global economy may be bottoming out just when everybody realizes that it's in dire straits here. If it does, then you get one of these vertical lines. If we could see it cross above its moving average next month, we get one of these vertical lines. And each time we get one of the vertical lines, it's signaling that the global economy is likely to turn up. You see what happens to the global stock market. It pretty well every situation here, except really that one there. But that was a very short-lived recovery. You get a rallying stock market. So that's something to watch out for. And here's another failed signal here. Again, that's that 2001 signal where the global economy started to improve, but the global stock markets did not. They had to go through that corrective phase until 2002. So here's an interesting indicator I haven't shown you before. This is world local new highs. What that indicator is it measures, looks at a basket or universe of individual country indexes that are making new highs over a 39-week time span. And since that data would be even more jagged than what we got here, we smooth that with an 8-month moving average. So that's what the 39 and the 8 mean. The idea is that when it falls below the green line for an extended period and then crosses above it, we get one of these vertical green lines. And that acts as a buy signal for the overall market. So you can see each time we've had an extended period. What's an extended period is a matter of judgment, really. But you can see there's a big difference between this period here and say that one there. So or these over here. I haven't included those. But here you can see it's a definite extended period, and we get a green line and a buy signal. And this happens all the way through here. All these buy signals were followed by a fairly dynamic rally in the stock market. And then we get here, last week, we got another signal And I would regard that as an extended period below the green line. So that's an encouraging sign, I think. So it tells us that the global markets, despite the weak economy, are kind of firming up, technically speaking. Turning now to commercial paper yield, money market rates in the US. This indicator here is my growth indicator. It's a momentum indicator that's kind of of several economic indicators that interest rates seem to be sensitive to. So when the indicator is below zero, that's when we and the commercial paper rate is below its 9-month moving average. That's when we get one of these red arrows, red highlights, indicating that short-term interest rates are in a bearish trend. And you can see that pretty well consistently all the way through. Every time it goes bearish, it tends to offer a strong signal. Sometimes it's a very short signal, as it was here, and it was there, but rates still nevertheless decline when we're in this kind of condition, where the indicator is below its zero line and the commercial paper yield is below its 9-month moving average. So we never know how long this condition is going to last. All we know is that while we're in that condition, it tends to be favorable for interest rates. If you look at all the big rallies in rates that have taken place, they've all occurred in the green area, where we see the opposite situation, where the indicator is above zero, excuse me, and the commercial paper yield is above its 9-month moving average. So right now, the indicator is bearish, indicating lower rates because it's below its moving average, and the growth indicator is below zero. But you can see it's not that far below zero. It wouldn't take much if some of those other indicators we were looking at before start to perk up. You would see this indicator reverse fairly quickly. And so right now it's bearish, and that's what we have to assume for rates. And then we look at the global economy itself. This is the CRB spot raw industrials. Because, we often compare U.S. commodity prices or dollar-based commodity prices with U.S. Economic indicators, and the signals line up reasonably well. But let's face it, commodities prices are really determined on a global basis, and this is a global indicator. This is the OECD leading indicators, and this is their normalized version. There are two versions. One's a normalized and the other one's the amplitude adjusted. And the amplitude adjusted has a longer lead time than the normalized indicators do. So it's more of a, you might say, a constant indicator. So what I've done here is I just put some vertical lines in where this indicator bottoms out, and you see what happens to commodity prices. They either go up, or in this case here, they go sideways. They went up for a little period, sideways, up, up, up. That was a failed signal where it gave us a buy signal right at the very peak of the commodity markets. None of these indicators I'm showing you are perfect, and we shouldn't expect them to be perfect. But what we want is some indicators that most of the time, in this case here, when they go bullish, they're followed by rising prices in the market that they're following, in this case, the commodity markets. So right now, the indicator is in a declining trend. It's gone a little bit flat here in the last month. But it's at a fairly oversold condition, and it hasn't dropped much below this oversold condition many times since the 1960s. So it's been 1, 2, 3, a little bit there, 4, and a little bit there, 5. Most of the time when it gets down here, it kind of indicates we're getting towards the end of the decline. So that's something to bear in mind, that although the world economy is definitely slowing down, it's reached the kind of overstretched level on the downside that we should be expecting to see it turn to the upside. I'm not saying it's going to, but we should expect to see it. And if the stock market, which is a leading indicator of the economy, is close to its highs, that's obviously a positive sign. It would be a negative sign if the stock market was below, the world stock index was below its 12-month moving average, for example, which it's not at this point. So before we get onto the StockCharts platform, I just go through our Somatic Diagram, which we do every month, where we look at the sectors in the U.S. market and where they are with their long-term KST. So we have basically four different quadrants we look at. First one is when the long-term KST is below zero and falling, above zero and falling, which we call fall. And then when it's below zero and falling, that's the worst it can get. So we call that winter. That's as cold as it gets. And then in spring, we get the indicator start. The long-term indicator starts to turn up. The KST starts to turn up. When you see a sector or a stock in that position, it tends to be bullish on a primary trend basis. And finally, the opposite of fall, which is summer, the market phase when the indicator is above zero and rising. So let's take a look this month, see where we are relative to fall, winter, spring, and summer. So the first thing we're looking at is bonds, and this is where the long-term KST for the bonds is right now. It's in this early summer phase. Now, when I say early summer phase, it doesn't have to go all the way up to the overstretched level and turn down. It could turn down at any point. But the expectancy is that when a market is in this position here, that it's probably going to work its way higher before it starts to turn down. But when it does, if it does turn down, that's something different. Stocks, on the other hand, the KST are kind of like this. They're in a fall position because they're below the long-term moving average, the 9-month moving average. But the actual KST has sort of gone flat. And what we've seen with a lot of sectors in the last few months is that they were over here in the fall position. And instead of transitioning to winter, they went straight to this position here where they were, first of all went flat and then started to turn up. So we'll look at a few of those later on. And this is what the S&P composite looks to me as if it's doing. It's going into a flat position prior to turning it to the upside. This would be, I would say, would be a low-risk buy signal, and up here I would say it would be a high-risk buy signal. But it's a buy signal, nevertheless, if it does start to turn up. This is where industrial commodity prices are right now. They're in the bear phase, well established in winter, but not yet showing any signs of turning into spring. Actually, I don't know what's happened to this diagram, but ideally, this curve here really theoretically should be over here. I don't know what happened to it in the last month, and I just noticed this. But some of you may be wondering why I'm putting demarcation line here instead of there, but this should be over here, or that should be over there, if you see what I mean. So what we're going to do is put up some early cycle leaders, sectors that tend to do well in the early stages of the bull market, and they're in red. And then we're going to put up the green, which is going to be the late cycle leaders, things earnings driven, things such as mining and resource based and basic industry stocks and so forth. So let's first of all look at the early cycle leaders, and you can see where they are clustered. It's all over here on the spring summer quadrant. A few of them are in fall, but a lot of them are in spring, and fairly well advanced. And I should say a lot of them are in summer, and some of them are getting fairly advanced right now. So when we put up the lagging indicators, what we're finding, or the lagging sectors, what we're finding is that a lot of those are over there on the summer position. Because when I first started featuring this approach back in January, most of these green arrows, the lagging sectors, were over here. And what they've done, instead of going into the winter condition and then transitioning into spring, they've moved straight over from fall into summer. And that's, as long as you have a lot of sectors in the summer and the spring position, if the majority are there, that tends to be bullish for the stock market. And bear market lows are typically seen when virtually all the groups are in this lower quadrant here of either winter or spring. So right now there's a very nice, healthy number of sectors which are in the summer position. We don't know how long they're going to stay in the summer position, but as long as they're in summer, that's positive for the overall market, and that's the way I see it. So I'm going to switch now to the StockCharts platform and go through a few more charts with you. So I need to get into the View All option here.
Looking good on my end.
There we go. Okay. So you can see that now, right, Greg?
Yes, I can. Yeah, we're all
Great.
good there.
Great. So here we have the New York Stock Exchange composite, and we have the KST, long-term KST in this panel here, and a COPOC indicator over here. COPOC is very similar to the KST, except it's more sensitive. So it tends to turn a little bit ahead of the KST, which you can see it started to turn up just here. And it gives a buy signal when it falls below zero or falls to zero, and then starts to turn up. And it's been fairly consistent over a long period of time over many different markets. But you can see what I mean about the S&P. Its KST has sort of gotten flat here, as we saw in the previous diagram. And usually when it goes flat, that's kind of a prelude to or often a prelude to a buy signal taking place. And since the COPOC has started to turn up, to me that suggests that the long-term KST is going to turn up too. And that's very important because we want to see the, excuse me, the NYSE composite break above this green trend line here, because that's obviously the neckline of a potential reverse head and shoulders here. So we're obviously in a very crucial position. The NYA is above its 12-month moving average, but I don't count too much for that right now because the NYA is in a trading range, and when you're in a trading range, you don't want to pay too much attention to moving averages because that's when they're most susceptible to false signals. You can see we've had a false sell there, a false buy there, a false sell there, and now we had another buy signal. So I want to wait and see the indicator cross above this green resistance trend line before concluding that it's formed this base and like to move higher. When we look at it on a weekly basis, it's got some interesting observation here, because if we draw a trend line a little bit differently, instead of joining those two peaks, but join the first peak with the other peak, the 2018 peaks with the 2019 peak here, it's clearly broken to the upside. And the 65-week exponential moving average here is also, it's above that, and that's moving up, as is the 40-week moving average here. The reason I put this chart in here is to kind of show you what happened in 2016 when we were 2012, 2013, when we were in a trading range here, just coming out of another growth slowdown. It was possible to draw a resistance trend line on that and on the 26-week rate of change, and when they were both violated, that gave us a signal at one. Then in 2016, coming out of another slowdown, we did the same thing with these blue trend lines here. Here's a resistance trend line for the price on the NYA, and here's a longer-term trend line, downtrend line for the rate of change at 2. That trend line on the rate of change got violated before the price, but once the price confirmed, we had a very nice rally leading into 2018. Fast forward to the present situation, we've obviously had a breakout in terms of this downtrend line on the most recent trading range, and you can see it's possible to draw an even longer trend line for the 26-week rate of change, which it broke out of back in June, and is pulling back a little bit now. But that's a very long-term trend line. That's been touched quite a few occasions. Once, twice, approached 3, touched 4, touched 5, touched 6. So it represents an important resistance level. And since it's a very long-term trend line, it has greater implications than if it's just could be constructed over maybe a 6 to 10 week period or so. This is many years. This goes back to 2009. So I think that's pretty encouraging from the point of view of seeing the equity market move higher. One other thing I noticed last month, I sometimes put up bar charts on a weekly basis, on a monthly basis, and take a look at them, because you look at the day-to-day stuff, you miss this longer-term stuff. And this is the NASDAQ, and it experienced a consolidation 2-bar reversal back here. That's August the 1st, today's data. So this would be July, and this would be June and May. So the 2-bar reversal was formed in June and May. Now, 2-bar reversals usually form as a reversal format, almost like this formation here. I wouldn't call that a 2-bar reversal, because 2-bar reversals are supposed to open on the high and close towards the low, and then the next one opens around the same level as the previous one closed, and that was obviously higher and closed near its high. So they're supposed to be equal bars normally. It has the 2-bar flavor though, where you come in and at the beginning of the month people are pessimistic because they sell the market off, and then by the end of the month, by the beginning of the next month, they're saying the same thing. That was June, and then at the end of the month, it's towards the high. So you've seen a complete reversal in trader sentiment from being bearish to being bullish, and that's the kind of the idea of a 2-bar reversal. So this one here is a better example of a 2-bar reversal, but instead of being a bearish 2-bar reversal, a bullish one at the beginning of a trend, it's a consolidation 2-bar reversal here, and you can see it's been confirmed by the fact the price broke above its previous high here, and is continuing to do that in the month of August. So we see this phenomenon in on the S&P here, same sort of thing, a different kind of a trend line we can draw, and we can see we can draw the same thing for the World Stock Index here, which corresponds fairly closely to what the NYA has been doing. So we see a 2-bar reversal here with a confirmation from these two bars above the upper level of the 2-bar reversal. Now the 2-bar reversal, consolidation 2-bar reversal, is only expected to have an effect for 5 to 10 bars. So if it was a daily bar, it would be 5 to 10 days, weekly 5 to 10 weeks. This happens to be a monthly, so we're looking at 5 months. Point I'm bringing it up is that you saw the other indicators were very finely balanced and need some kind of move up or down to kind of get a solid trend emerging. So what I'm pointing out with these consolidation 2-bar reversals is that they probably have the power to push these indicators, which are tentatively bullish, like that inverted dividend yield and some of the others that I showed you last month, in more firmly into the bullish camp. So that's the reason for showing that. Now we're looking at stocks versus bonds. And in this case here, rising ratio favors stocks, a falling ratio favors bonds. And you can see that peaked in January of 2018. It's never recovered to that high. And the ratio has been sort of kept below this resistance trend line here ever since. And that's an important resistance trend line because it's been touched on several occasions. And the 200-day moving average is in the same sort of vicinity. So underneath we have the special K indicator. This is a combination of short-term, intermediate, and long-term momentum all combined into one indicator. So you get the big swings, and yet the inclusion of the short and the intermediate components give you a kind of a jagged feel. And when the indicator reverses direction, typically that's going to be when the price reverses direction as well. But that's easy with the benefit of hindsight, so we've got to find some kind of a way of tracking it in real time. And one of the ways I do that is to look at the special K relative to its signal line. That's this red line here, 100-day moving average of 100-day moving average, and a trend line. So when I see a trend line and a moving average in the same direction, they both represent formidable resistance. And when they've been violated on the upside, that's a very positive sign, signaling usually that the special K itself has reversed direction. And 7 times out of 10, when the special K reverses direction, so too does the price. And you can see several examples here of where the price peaked here, then went sideways for a while, and where it bottomed out towards here, and then in 2018, more or less peaked with the ratio itself. So the ratio now is in a trading range bound by these two trend lines, and yet the special K is kind of just broken above this trend line. Now, a couple of things that are a little bit problematic about this trend line is it is a trend line, and it's extending back to November, December last year. So it's about 9 months in construction, but it hasn't crossed the signal line yet. And it's just kind of an anemic break above this downtrend line. So it looks kind of encouraging from the point of view of stocks relative to bonds, but I'd like to see something a little bit stronger especially as it broke below this red trend line here, and it looked like it was rallying back above the line, but it hasn't decisively done that. So that's one of the things that hopefully that two-bar reversal will, if you want to be bullish on stocks, that's hopefully one of the things that two-bar reversal, consolidation reversal will do. It'll push stocks up at the expense of bonds. We'll get to bonds a little bit later. Another thing which, again, is kind of on the cusp are these, what I call confidence indicators, where we compare a risky item with a safety item. In this case here, what we're doing is we're comparing the Fidelity Capital and Income Fund with the Vanguard Treasury. Vanguard Treasury, obviously the safety fund. Vanguard Fidelity Capital and Income is more of a high yield bond ETF, mutual fund. So when it's rising, it means that people are growing in confidence because they're willing to overlook the safety of the treasuries in favor of the better return being offered by the high yield fund. And when this indicator is moving up, it also indicates that bond investors have confidence in the economy. Because if they have confidence in the economy, that means they're not concerned about defaults. And if they're not concerned about defaults, they're going to go for the higher yield rather than the safety of the treasury. Well, you can see it's caught between two trend lines here. And it's actually very close to breaking below the this red trend line here, support line. And in fact, it did and then bounced back, which is kind of encouraging. And it's going to be kind of interesting to see if it can build on that breakout or whether what's happened in the last, the daily chart, the last 4 or 5 days where it started to move down. So it's going to be kind of interesting to see what happens with these confidence indicators. Another one you can follow is looking at the HYG, the iBox Corporate High Yield Fund, against the IEF, which is a 7 to 10 year treasury. That's another indicator that tells us similar stuff about confidence in the bond market and therefore confidence about where the economy is going. So we're not seeing at this point a green light towards the economy. We're seeing a kind of a no man's land here where it broke below and then it's still managing to hold above. So we'll see what happens there. And the same thing with this one here. This is the S&P high beta versus the high quality. The SPHB high beta against SPHQ high quality. And this indicator is, this ratio is again basically caught between these two trend lines, although it's I think this is this is the 31st of July, and it's just a little bit below that red trend line. So that's what I'm watching very closely. I'd like to see these indicators start to move up. The other thing is, you look at the ratio here, is just below this green trend line and the 200-day moving average. You can't see the 200-day moving average because it's covered by the trend line. So again, it goes back to that idea of the trend line and the moving average reinforcing each other as a resistance level. So if it starts to move above that level, and the moving average looks like it was at 1.3 on this ratio, that would be very positive for the ratio, and also suggest that the economy is headed higher as well, and that would be positive. Next chart shows you that the S&P against the EFA, basically the rest of the world, the S&P against the rest of the world, the MSCI Europe, Asia, Australia, Far East Index, the S&P is breaking out against the rest of the world and looks pretty positive. Now move on to interest rates. Here's a 1-year yield, and I put this up because it just recently crossed below its 12-month moving average. That's what these other red lines or red arrows denote. When it's crossed below the moving average, it tends to be a decisive signal. And the momentum is weak too. When that sort of chart sort of agrees with what the chart I showed you before about the 3-month commercial paper yield was doing. That was below its 9-month moving average. So we're looking at the 10-year yield. And one of the points I made right at the beginning was that the 12-month rate of change, which is shown in the bottom panel here, is overextended at the present time. You can see it's down here at the minus 30% level. And it can go lower, of course, as it has in the past, but not many times has it gone lower. And when it's reversed to the upside, you get one of these green arrows. And you see, look at all these green arrows here are basically followed by some kind of a rally in the yield. Sometimes a small rally like this one here, and sometimes it's a more significant rally. We don't know when it turns. Right now, it's at the overstretched level, which suggests to me that it may be in that it's still bearish, but it's in a position where it could easily turn to the upside. Say, for example, the commodity prices started to suddenly turn up. That's the sort of thing which could spook the bond market. So let's just take a look at some of the shorter term indicators to see whether or not this indicator here stands the possibility of reversing to the upside. We'll also look at some other yields to see where they are. So I'm going to change the panel here and now move to the 10-year yield again. This time it's a weekly chart, and what you can see is that the short-term KST here has started to move up. This is August the 1st here, and of course the chart won't be valid as a close until Friday's close, and we're looking at Thursday right now, mid-morning Thursday. So we don't know where this is going to close, but at this point, the short-term KST has turned up, suggesting that there's a possibility the 10-year could rally, but it's going to have to fight against the intermediate series, which is down, and the long-term series, which is also down. But don't forget what the 12-month rate of change is doing, and that's at a very overextended level on the downside at this point. So now looking at the 5-year yield, and this chart here is just to kind of give you a long-term perspective. What I've done here is I put these waves indicating cyclical bull and bear markets. And just to point out that the peaks and troughs were in a declining phase with these red trend lines here. And then it turned into a positive secular trend here. And that trend of rising peaks and troughs, and that was not known at this point here, but when it crossed above this line here, that meant we had a series of rising peaks and rising troughs at that point there. And then, of course, we continued that on into 2018, the middle of 2018. And now we've seen a correction against that trend. So that suggests to me that the secular trend of the 5-year yield, which we can't say for the longer term yields, the secular trend is an upward one, and that this is a counter secular correction. So let's take a look and see where that is now on a weekly chart. So here's the 5-year yield again. And now again, looking at a 52-week rate of change here. And the green arrows represent, the solid green arrows represent a period when the rate of change is reversed direction successfully. What we've seen is a rally in the 5-year yield. The dashed green lines indicate when it reversed, but it was an invalid signal. In other words, we didn't get a rally in yields following it. So there's been a couple of exceptions since 1995, but the vast majority of reversals from this oversold level have been followed by a rally in yields. So right now we're, again, like the 10-year series, we're at an oversold reading. But we're going to get, I think, a clearer picture of what's going on, because here's a daily chart of the 5-year yield, and it shows that there's a possibility here of a reverse head and shoulders forming here. And if the yield rallies back above the 1.9% level, that would indicate that the head and shoulder, reverse head and shoulders had been completed. So we're assuming, or I'm assuming, that the overall trend of yields is down, but I'm very suspicious because the 12-month rate of change and the 52-month rate of change of the 5 and the 10-year yield are very overstretched. So what I'm looking for is some kind of a signal to confirm that there's been a reversal in that 12-month and 52-month rate of change. And to me, that would come if the 5-year yield were to rally above the 1.9 or 1.95% area. In the meantime, we're assuming that this is just a ongoing trading range in the bear market yields. But we're going to have to see how this works out in the next few weeks. So it's very, very finely balanced indeed. Here's an indicator that suggests that bond yields are headed higher. This is a stock This is a chart of the IEF, which is bond prices. Of course, bond prices and yields move in opposite directions. And this is my net new high bond indicator, which you can plot with this symbol here. Explanation mark PRNNHBND. And typically when that peaks out, you get one of these red arrows here. The dashed arrows represent failed signals, and the solid arrows represent what I consider to be successful signals. And we've had 2 failed signals, and now we got another one. And it looks like it may be forming a head and shoulders top. It may not. It may just bounce back again and rally up to here. We don't know. We're obviously going to have to wait and see on that. But it's not in a kind of position that will be encouraging for higher bond prices. Doesn't mean to say we can't have higher bond prices, but the indicator right now is leaning towards the bearish side. So now I'm going to say a little bit about commodity prices. This is the CRB composites, a monthly chart. And underneath is the inflation-deflation ratio, which you can plot on StockCharts with those symbols just there. The inflation indicator, the inflation part of the ratio is an index of 4 different sectors or industry groups that tend to do well when commodity prices move up. They tend to do well when at the tail end of the cycle when things are pretty tight. Things like resource-based stocks, basic industry, and so forth. Whereas the deflation part of the ratio is, again, a similar index constructed from 4 different interest-sensitive and deflation sectors, things like utilities and REITs and that kind of thing, that tend to do well at the beginning part of the cycle. So basically what this is a stock market's way of voting on inflation-sensitive stocks, or deflation through the deflation indexes. So when it's rising, it's inflationary, and it moves up in sympathy with what the CRB composite is doing. You notice I got some dashed arrows here. That sort of indicates that there is a kind of a leading tendency where the stock market tends to act ahead of the CRB composite. It doesn't happen in every situation. Like here, for example, they both peak simultaneously. But in most situations, you see that the inflation-deflation ratio leads the stock market. That leads us to the current situation where the inflation-deflation ratio is back down here, very, very close to its previous low. And the question is, does it bounce on that low and lead commodities higher? Or does it go through that low and we see a sell-off, a further sell-off in commodities? That's the big question. And if that's the case, then presumably the CRB composite would break below this trend line here, which I just noticed has not been properly drawn. You know, you can't draw a trend line just joining 1 point as I've done here. You have to join at least 2 points. So this trend line should be a little bit of a steeper angle joining this low with that low with that low. So I apologize for that, but at least it's an important point because you cannot draw a trend line just touching 1 point. It doesn't make sense. So anyway, there's a potential head and shoulders, consolidation head and shoulders in the making here. And at the same time, it may be that the inflation-deflation ratio breaks below its trend line. On the other hand, we could break above the purple trend lines, which are equally as valid. And if that happens, then you'd see a very strong rally in commodity prices. And that goes back to the initial charts I was showing you when I was looking at the other presentation, where we were seeing that the economy is in a very fine state of balance here. So to it, and that's very much reflected in what the commodity market's doing here and what the inflation-deflation ratio is doing. A very fine state of technical balance here. I'm going to skip on a little bit here because I'm running a little bit late, and I know Greg has some questions he wants to answer me. Just going to show you this. The DB base metal fund is right at this potential neckline of a head and shoulders to top. It hasn't broken down here, but if it does, that will be a bit of an indication. And if it's if it holds below this red line, that would be a bit of a valid situation that we're going to see lower commodity prices. And so we have to wait and see what happens. On the other hand, if it breaks above the 1560 level, it's going to complete this small base, which would be positive. So well worth watching what's happening to the DB base metal index. Now we're looking at the US dollar. This is plotted up to the 31st of July. And you can see that it's in a bull market because it's above its 12-month moving average. Last month it tried to drop below it, and it did for 1 month for a very, very small amount, and now it's rallied back again, which I think is a positive sign. And you can see the KST has started slightly, it's bullish, but it's started to reaccelerate to the upside. When we look at it in a greater detail on the next panel, when it comes up, and here it is. We're doing this on the morning of August 1st, and the US dollar index is actually above this line. This chart's only plotted because it's only plotted up to the end of day, which is the 31st of July, and it's right at this trend line. This morning it would have gone up through that trend line if we had the data, and you can see also that it's broken above the KST is broken above this. The special K is broken above this trend line. It's also above its signal line, and that's very positive too. So it looks to me like the dollar is headed higher. I thought it was going to come under pressure last month when it crossed below this line here, but that turned out to be a false break above the 200-day moving average and the price and the trend line. So that tends to be a very positive development. You get a false breakout because you get a lot of people who went short and they have to regain their positions or rebalance their positions, and you have the people who are long anyway all buying, so you tend to get a very strong rally coming out of a false break. So here's the USDU, which is plotted up to the 1st of August, and that's a more broadly based index than this is the Wisdom Tree Bloomberg US dollar bullish fund, which is a broader based index than the dollar index itself. Dollar index itself has a 57% weighting in the euro, which is a little bit high, I think. But you can see that on a broad basis, the indexes or the price of the fund is definitely broken out on a strong basis. Now, it's not the end of the day yet. We're only looking at 11 o'clock, 10 o'clock or so. So it's early in the day yet. Again, we have to see what happens, but it looks like there's a pretty solid breakout there. And supporting that idea is the fact that all three KSTs, excuse me, are in a positive trend here. So that suggests that it's moving higher. Here's I'm going to go through these other ones very quickly, except showing you the British pound's at a very crucial level here on the 1st of August. Key support level right back to its low of 2016, and we're seeing all three KSTs turning down. So here's the point of last return at just around 121 or 1.21, because that represents the low of the previous move. So until it rallies above the 130 level where this trend line is, or a little bit below where above where the trend line is, and the 65-week exponential moving average, I think you got to remain bearish overall on the pound on its long-term trend. And so I just wanted to show you one chart here. I mentioned about the Canadian dollar. That's something worth watching. Here's the CRB composite. Here's the Canadian dollar. You can see they move fairly closely together. And once again, they're both in this trading range, which could be a base, and it could be a consolidation pattern during an ongoing bear market. This chart here shows that the Canadian dollar is still confined below this trend line here, but you can draw the trend lines in, and that the KST is still bearish. But I could turn that around and say, okay, the Canadian dollar is broken above this downtrend line because I've drawn the trend line a little bit differently here, and then I could look at the COPOC indicator, which tends to lead the KST. KST in the previous chart was bearish, but the COPOC's bullish, and it was below the previous trend line, and now it's above this trend line here and above its 12-month moving average. If that is a valid break above the trend line, then I would expect it to move significantly higher, and if that does that, that would suggest that, given its relationship with the commodity markets, the Canadian dollar is moving higher, and the commodity markets are moving higher. So it depends really on how you interpret it. One final chart is this global gold. It's my own indicator. It's plotted up to the 26th of July. I didn't have a chance to get it to the end of this week yet. and it's broken out solidly to a new high. And I bring it up because a lot of people know that gold and the dollar move inversely. But there are periods of time when the gold and the dollar move in the same direction. Not very often, but sometimes do, because they're both bullish right now. And this global gold suggests to me that gold is going up in its own right because it's broken out here, not so much because it's going up against the dollar. So I think I've finished what I have to say, Greg. See if you have any questions to bring up here.
You know, Martin, I didn't see a chart on copper, but that chart's sitting on a 3-year trend line. Probably your DBB chart is as close to that. But what do you think about the industrial metals here?
Well, as I said with the DBD, it's at a very critical point. You're absolutely right. Let me see if I can move back to it here. And it will be in the previous thing. Yeah, I mean, it's resting very much on a important support line, the DBB, sorry.
Yeah.
Let's see if I can get to it. There it is. So yeah, and a copper chart's not much different because of course this is dominated, the base metal index is dominated by copper. So, and copper has earned a degree, a PhD, because it's used in so many things, and therefore it tends to be a reflection, its price tends to be a reflection of what's going on with the global economy. So again, it underpins the point I'm saying that things, while I think they're leaning towards the bullish side, towards the recovery side, I could easily change that view if this chart starts to break down and stays broken down, because it would reflect, and I would look at copper at the same time, and the copper is doing pretty well the same thing as the DBB.
Yeah, I'm very interested to see where we shake out here to finish up Friday. After the Fed meeting, I usually expect some shaking, and we got a little bit of that. Interesting, today gold is down hard, but the gold miners aren't down hard. They've been rebounding all day in the face of that strong dollar. So lots of changes out there. I think the one thing that I'm continually watching is just to see whether or not some of the European markets like Germany hold up and Japan hold up, because they really haven't rallied very well considering how much the US has rallied. Yeah,
that's right. And you saw that chart where the S&P is beating the rest of the world. It's much stronger than the rest of the world. So also a lot of these international markets, the developed ones, have bearish long-term KSTs still. They haven't started to turn to the upside. And individually, their relative strength is in a long-term downtrend. So the US is probably, relatively speaking, the place to be. And if it breaks to the upside, it definitely will be the place to be. So,
yeah, I would agree. I think that's one of the big concerns I have. I keep trying to figure out, we're getting negative PMIs all over the world, or not negative, but below 50. And so purchasing managers indexes. And yet the market keeps kind of holding on here. So I don't know if there's just a lot of hope around trade or, or whether the summer doldrums are about to hit us here now that the Fed is kind of agreeing with that.
That's a good point because, pointing out the economy is very finely balanced here. So it's obviously going to be more sensitive to any exogenous force that takes place here. Maybe it's good trade news, maybe it's bad trade news with China, maybe it's a good Brexit or a bad Brexit, which affects the European side, which tips the balance. So we don't have indicators for any of this stuff. That's the problem.
Yeah, you're right.
All we can do is go what the markets themselves are telling us and go with the hand we're dealt with, not with the hand we'd like to be dealt with.
Yeah. Okay. Hey, Martin, thanks for taking the time. We really appreciate you showing us the charts, and we look forward to catching up with you again next month. Thanks again.
Thank you, Greg. Thank you, folks.